Welcome to Wall Street versus Main Street, a different take on the investment show with our host, Dax White. Dax White is the managing partner of the White Law Group, a national securities fraud, securities arbitration, and investor protection law firm with offices in Chicago, Illinois, and Vero Beach, Florida. The White Law Group has represented hundreds of investors in FINRA arbitration claims against their brokerage firms, and throughout this show, Mr. White will shine a light on some of the tricks of the brokerage industry, while also providing valuable information for investors on how to successfully navigate the investor-financial advisor relationship.
Welcome, everyone. My name is Dax White, and I'm the host of Wall Street versus Main Street. As our lead-in indicated, this is sort of a different take on the investment show. Our objective is not to give an investment advice, tell you what to buy, sell, etc. I'm not a licensed investment professional. Rather, I'm a securities attorney who represents investors in claims against their brokerage firm. And through the years of doing that, there's certain things that I've come to know about the industry that I wish more investors knew. And so the objective of the show is to pass along some of that information and try to even the playing field a little bit so that in your next interaction with your financial advisor, you'll be better equipped to ask the right questions, protect yourself, and make sure you're getting the investment advice that you expect and that you want. So each week we'll tackle different topics and hopefully through that be able to pass along some of that information. Today we're going to answer some questions that have come up. Things that are on people's mind that they wanted me to address, just to, questions and answers segment. And without further ado, let's jump into it. What's our first question?
I have seen a bunch of commercials advertising MLPs. What are they? And is there anything I should be concerned about before investing in one?
That's a great question. I think it's topical. I've seen these same ads. I almost religiously watch CNBC in the morning while I work out. And in particular, I think I recall seeing an Alarian MLP ETF ad that's running periodically right now. So they're certainly out there. I'm not surprised that other people have been seeing them. MLPs, it's a new way of investing in generally energy, natural resources, sometimes real estate. But basically, it's a way that an investment is structured to take advantage of certain tax rules that are out there. The parameters are that 90% of the partnership, its cash flows have to come from certain criterion. And the advantage, in theory, is that it combines certain tax benefits of it being a limited partnership with the liquidity of being publicly traded, because these are there's stock tickers and you can trade these publicly. So it's sort of a next generation to what we've been seeing over the last few years in our practice, which would be oil and gas and limited partnerships, where there wasn't necessarily that liquidity. So this takes it a step further and provides that. But it doesn't necessarily do so without some risk to investors. So the ads I've seen and undoubtedly what this person is referring to sort of sell on the income that can be provided from these investments. And certainly if you're a retired investor who needs income for retirement, it could appeal to you. But it doesn't talk about, and what would certainly need to be discussed before deciding whether to invest in it would be the risks that come with it. The reality is these investments are typically, like I said, they're commodities driven. They're either oil and gas deals, maybe real estate, other commodities. And as we've seen over the last year to 18 months, the commodities market, in particular oil, has suffered enormous losses. In these MLPs, it's the same. I've checked recently, and a lot of these MLP funds are down 50, 60, 70% over the last year. So while you might be getting an income stream of 5 to 6%, and that's what you want, if you're eroding your principal so enormously, it's not going to do you any good long term. Your money's going to evaporate. Some of the ones that we've seen that are common out there are that Alarian MLP ETF that I mentioned. And that, if this was the play for you, and obviously I can't give investment advice, but if you wanted that kind of exposure, maybe that's the safer way to do it, just because that is structured as sort of a mutual fund, if you want, of various MLPs. And so you don't have at least a specific risk of a particular MLP going under. You're buying a basket of them. So that's the Alerium MLP ETF. But the other ones we've seen in terms of the people who have put these deals together, Enbridge Energy Partners, American Midstream, Columbia Pipeline, Midcoast Energy, MarkWest Energy, EnLink. There's a variety of them. I think there's like 20 or 30 that I've seen recently, and I'm sure there's more even than that. But the ones that have been suffering the big losses again are the oil and gas MLPs. And certainly, while there are those advantages in terms of income, just like with any investment, you're going to want to look at the diversification. You're going to want to look at how much exposure do I want, and then you're going to want to look at your risk versus return, because there's a direct correlation between the amount of risk you're taking and the possible return. So when you see these advertisements that are advertising income of 5, 6, 7%, and basically a zero yield environment because interest rates are at zero. So if you have an investment that's paying that much, typically in order to get there, it's going to have to involve an enormous amount of risk. 8, 9 years ago, when CDs were paying 5%, then to have an investment that paid 5 or 6%, you could typically assume that it was going to be pretty safe. But in today's market climate, if that's what it's touting is this large income stream, it's probably getting there with an amount of risk that should be considered before making that investment. What's the next question?
What are some risks to the markets of the Fed in potentially raising rates?
Sure. So that's certainly if you watch investment programs, that's something that's going to be a hot button issue right now as the Fed is meeting very shortly to decide whether or not to finally raise rates after a zero rate environment for going on before even 2008 market correction. And that's going to create some volatility in the market as the marketplace tries to figure out how that's going to impact some investments. What I would anticipate is that it will flush out some bad investments that are already in the market that have been able to exist in a zero rate environment without too much volatility. But as rates rise, they'll be exposed. In particular, I'd be looking at junk bonds and risky corporate debt. These are investments that if you were chasing yield, which is a frightening thing to be doing right now, if you're a retired investor, I'm sorry. I'm sorry the Fed has kept rates this low for this long, because of course the problem is, you're retired and you expected to live on 4% of your money, and it's really hard to find 4% right now. So you're looking for yield. And in this environment, what you would need to do to find it is to start looking at more and more distressed debt, like junk bonds, like risky corporate debt. And what's going to happen is, as the Fed raises rates, is those investments will become less attractive. Right now, they've got a spread of, let's say you've got a corporate bond paying 5 or 6%, interest rates are at zero. There's going to be a premium there, people who are willing to accept the risk because of that premium. But as interest rates rise, you get more on your CDs, you're going to get more on your corporate bonds that are safer. You're not going to want to buy junk bonds because you're not going to need that much yield. And that's going to reduce the value of those investments as just a supply and demand as fewer people want them. The other thing that's going to probably happen is it's going to make it harder for companies to refinance bad debt. So let's say you're an energy company who raised money to do oil and gas exploration, and you've got certain problems because of oil prices regardless. But let's say that you went to a bank and you took out a loan based off of some multiple of your reserves, and now that loan comes due and it's time to refinance. If you've got a bad balance sheet, you're number one, you're going to have a hard time refinancing. But even if you do, you're going to be refinancing at less favorable terms to you. It's now going to get more expensive. And again, if you're an energy company, if your debt's more expensive and your oil reserves are now worth less, you're going to have a credit crunch there. So, certainly we're seeing it already in some energy investments. And I'm not talking about the big boys. It seems like your Exxons, your ConocoPhillips's, and your BP, they have a very long-term horizon. They're looking 20, 30 years, and short-term price movements don't really seem to affect them in the same way that some of the smaller players are. And again, you're seeing it. There's a host of bankruptcies already with oil and gas companies. I think the number is over 30 this year. They're anticipating many more. And it's all sort of related to this same thing, which is, the way that they borrow money is based off of the oil in the ground. The bank evaluates how much that oil is worth. And when the oil prices tank, now you've got less valuable reserves. And, oh, by the way, now you got to borrow money again, and it's harder to refinance because of the raising rates. One counter to that is I would expect as the Fed raises rates, the banks should do better because obviously they loan money, and as yields or as rates go up, they should be making more money off of those loans, unless you're a bank who's already overexposed to some of that risky debt that's out there. So, I mean, it would sort of depend on which bank you're talking about. But again, the rate moving is going to sort of flush out a lot of stuff. A one-time move is probably not going to be catastrophic for anyone in any particular direction. But I think what the market really is monitoring is sort of long-term what's going to happen, not necessarily what the Fed will do this coming week, but, what are they going to do as they try to normalize? And if you start seeing, 2, 3, 4 moves of 25 basis points, then yeah, I mean, some of these bad junk bond investments are going to be in trouble. What's the next question?
If your business is countercyclical, what kinds of things do you see when the market is going up?
Sure. Obviously, as a security attorney that represents investors in claims against brokerage firms, our business actually is very much countercyclical. Typically, when the market is rising, there's fewer people who are upset with their financial advisor, not necessarily because they're not still getting ripped off, but look at 2014. If the market's up 30%, and you're only up 10 to 15%, you might be unhappy with your financial advisor. You might be looking for a new financial advisor, but you're not necessarily going to sue them. And so it usually is when the market corrects and maybe the market's down 20%, but you're down 50%, that you're sufficiently mad enough to call somebody like me. So that is typically when we get busy. 2008 happened, and 2009 through really 13, 14 were very busy years. And now you're sitting here, we haven't had a market correction in 7 years, and things have slowed, and just in terms of volume. But we still see stuff, and it's things that would happen regardless of what's happening in the market. Again, fraud or bad advice from advisors is happening regardless. It does typically take a market correction to sort of flush it out, make it so that you're aware of it. But there's certain types of fraud that, regardless of what's happening externally in markets, you're still going to figure it out. And those are what I call your like lone wolf brokers, or your one-off brokers, where you just have, a bad guy or girl who is taking advantage of clients, whether it be through theft or, a Ponzi scheme, or, investments away from their firm that their firm doesn't know about. That kind of stuff's happening all the time, unfortunately. It's rarer than just your sort of garden variety, overconcentration or negligence or what have you that gets flushed out in the bad markets. But it happens regardless of cycle, regardless of, what's happening in the marketplace. So we will always have those types of cases. The other things that we see when the market is good, that usually increases as opposed to decreases, so it would be cyclical as opposed to counter-cyclical, would be churning claims. Churning is when your financial advisor turns over the account at such an aggressive pace that there really could be no justification for it in terms of being suitable for you, and can clearly just be to enrich the advisor that's doing the trading. And we see that actually more when the market's going up, because it's just easier to get away with. Again, going back to 2014, when the market was up, maybe 30%, it's easier for a financial advisor to be turning that account over and over and over again to create commissions, but still creating a profit such that you think, well, maybe I'm getting a lot of confirmation slips in the mail, but, I'm still up. So he's doing something right. But maybe you're not up as much as you should be. And so, that's the type of claim that we would see even more when the markets are going up, because it's just, like I said, it's easier for financial advisors to sort of think, well, my commissions are down this year. Which of my clients do I think I could trade a bunch in their account and they wouldn't notice or wouldn't care or what have you. So we see those when the markets are going up. And then Occasionally, we'll see what would be just called a gross underperformance case. These are pretty difficult cases, but it depends, factually on what's occurring. Again, 2014 being an example. Let's say the market's up 30%, but you're only up 5%. Maybe there's a legitimate reason for that. Maybe the reason you're up 5% is because your profile is such that you shouldn't really be in the equities market. It's the S&P that was up 30%. Maybe you're 88 years old and you need income and safety. And so you should probably not be experiencing that 30% increase. And for you to have a 5% increase is probably perfect for what your objectives would be. But for other investors, we've got some ongoing cases right now where 2014 market's up 30%. They're invested in equity funds that grossly underperform the market. We have some where they actually went down a little bit. And if the market had been going down and they were down a little bit, I probably don't take the case. But the reason it becomes an actionable claim is because these are people who are actually looking to capture, market growth, but they're in over-concentrated into poorly managed funds at the recommendation of their financial advisor that actually didn't track the market. So what you're looking at is the difference between the 30% growth and where they actually performed. So those are cases that we would still see regardless of what's happening in the market, where you're just underperforming relative to benchmarks. Again, they're rarer, but that's the type of case we might see, again, counter-cyclically, even when the market's going up. Those are the questions we had for today. We're going to take a commercial break. And then when we come back, I'll pass along some more information that I think that investors might want.
Hi, I'm Cindy, the proud owner of Cindy's Cleaning Service. I consider it a privilege to be welcomed to people's homes and offices to make them shine. We do it all from ceiling fans to floors, dusting, and windows. With Cindy's Cleaning Service, you get quality cleaning and affordable rates. We are also licensed and insured. Please give us a call and we will give you a free estimate. Cindy's Cleaning Service, 569-9348. At Cindy's Cleaning Service, the Lord is our strength.
Minuteman Press of Vero Beach, covering the Treasure Coast from Port St. Lucie to Sebastian, can handle all your printing and copying needs, from large format and blueprints to business cards and brochures, plus a full line of promotional products. Minuteman Press of Vero Beach. Google it.
1-800-HI-MITCH. What's that number and who is Mitch? 1-800-HI-MITCH is the number for Mitch Maxfield's Carpet and Furniture Cleaning Services. Serving Florida's Treasure and Space Coast for over 30 years, and Mitch still does the work all himself. Call 1-800-HI-MITCH. Mitch Maxfield personally will clean your home or business. Call now for 2 rooms of carpet cleaning for $77 or a 6-foot sofa for $66. Maxfield Carpet Cleaning is a member of the iTex trading community and welcomes your iTex dollars. 1-800-HI-MITCH.
For unto us a son is given, unto us a Savior is born. Merry Christmas from Chad and Joey Colquitt and everyone at Colquitt Air Conditioning, keeping Indian River County cool and comfortable for the past 45 years.
The season bright. Take a ride on the quiet side. Pontoon tours available on Blue Cypress Lake, or rent a boat and go fishing. Merry Christmas from everyone at Middleton Fish Camp.
Welcome back, everyone. You're listening to Wall Street versus Main Street. I'm your host, Dax White. Each week, we try to pass along information to investors that I think, based on my experience as a security attorney, that people would like to know about the brokerage industry, so that we can try to improve that relationship between you and your financial advisor. Obviously, it's a very important one. You're entrusting all of your life savings, all of your hard work with an individual, and you want to make sure that you're picking the right person, you're getting the right advice. And each week we try to tackle those topics and pass along that information. Before the break, I answered some questions. Now I just want to mention where you can find some of those resources that I would think that would be informative for you. The best way is to go to our website. It's wallstreetvmainstreet.com. On there, you're going to find information on how to contact us in case you have a question you want to answer in a future week. I would certainly encourage you to do so. You're also going to see literature on sort of well-managed, best practices on investing, how to make sure that you're properly diversified, And you can certainly read that and make sure, in talking to your financial advisor, you're sort of doing that in your own portfolio. You're also going to see literature on the impact of commissions on your portfolio. There's a lot of studies out there that will talk about how, if you're overpaying for your advice, how that can really erode the performance of your portfolio over the long term. It sounds like, okay, well, maybe I'm paying 0.5% more than I should, but I like this person and, I think they're doing a good job for me. And you're thinking, well, I've got a $100,000 portfolio. I mean, we're talking about a couple $100. These studies show that over the course, let's say you're in your late 30s like me. By the time I retire, we're talking 30 possible years. It starts to add up when you start compounding those things. And so you can have the difference between maybe a portfolio when you're now in your 60s of 600,000 versus 900,000. And that can make a huge deal. It just really starts to compound. There's literature on our website on that. There's also information there on how to locate regulators. If you see a problem and you want to report it, there's links to those, how to file an arbitration claim if you think that you want to do that. And then there's also a link there on how to research your financial advisor. And I know I've talked about this in previous episodes, but I think it's probably the most important thing that we do with this show, which is just to let people know, and I wish everyone knew this, that you can look up your financial advisor. You can find out all the information that you would want to know on whether or not I want to stay with this person, hire this person, wherever you're at in that relationship. You can go to FINRA's website. FINRA is the regulatory body for the brokerage industry here in the United States. Go to finra.org, FINRA.org. And again, this is on our website as well. But go to finra.org, and in the upper right-hand corner, there's something that says broker check. All you have to do is type their name in there. It's going to spit out a report. The report says how they did on their licensing exams. Have they ever declared bankruptcy? Have they had any liens on them? Have they ever been sued by a customer before? Have they ever been fired by one of their employers? All the things, to me at least, that would be, if you're evaluating whether or not I want to trust my life savings with someone, it's all there. And there's so many times where people call us and the person had already been sued 20 times when they hired them, and you just wish they knew that, because maybe they wouldn't be in this situation. So again, I would invite you to check out our website or go to FINRA directly if you want, but check out your financial advisor. Other resources that you could look at would be our law firm's website. That's whitesecuritieslaw.com. On there, you'll see all kinds of information on current investigations that we're doing, cases that we've filed, the various places that we've been quoted in newspapers throughout the country, information on me, whatever. You can also find us on Twitter and LinkedIn and Facebook and any other social media that you would want. But certainly, again, the objective of the show is to pass on this information. I would invite you to check out at least the Wall Street v. Main Street website, because a lot of that information's there that would provide you and arm you with some of that information to really improve your relationship either with your existing person or to motivate you to go find somebody who's going to do a great job for you. Because I can tell you from experience, there are great financial advisors out there. We deal with sort of the worst of the worst. And I wish that people just never had to encounter that, because it can be really catastrophic for them. But there are tools to help you to go find the good people, find the ones that are going to take care of you, give you that advice that you need so that you can make sure that you really are set up to retire, and have the performance you need, the growth that you need in your portfolio to get to where you want to be. Or if you're already retired, somebody who can help you to meet those income needs going forward, so that you don't have to worry about running out of money or being a burden on family or anything like that. So check out wallstreetversusmainstreet.com. Tune in next week. I'll be answering more questions, and thank you for listening.
You've been listening to Wall Street versus Main Street. The views expressed by the participants of the program are their own and do not represent the views of, nor are they endorsed by, the White Law Group, its officers, directors, employees, agents, representatives, shareholders, nor any of its subsidiaries. None of the content should be considered legal advice. As always, consult a lawyer.